Hello everyone, welcome to MCA Accounting Series. In today's class, we'll be taking a look at a topic, accounting concepts and convention. Objective of topic. At the end of this class, students should be able to 1. Identify accounting concepts and 2. Explain accounting concepts. What are accounting concepts and convention? These are principles that must be taken into consideration when preparing the accounting statements. For example, the accounting statement comprises of the final account of the sole proprietor. They are so basic that if any of them is altered, the entire nature of financial accounting will change. Over the centuries during which the financial accounting profession has developed, a body of principle has evolved to regulate the practice of accounting profession so that the preparation of final statements is guided by consistent and acceptable principles. These principles are known as GAAP, generally acceptable accounting principles. It's worthy to add at this point that accounting concepts or convention is the bedrock on which accounting is built. It's very important to have a clear understanding of what it's all about to be able to apply application. For the purpose of easy understanding, this topic has been divided into 2 subdivisions. 1. Underlining accounting concepts and fundamental accounting concepts. So, I'm going to start with underlining accounting concepts. Under underlining accounting concepts, it's further divided into historical cost concepts, money measurement concepts, business entity concepts, dual concepts, and periodicity concepts. For better understanding, we're going to take it one at a time. Historical cost concept. It means that assets are normally shown at cost price, that is, the cost of acquisition, and that this is the basis for valuation of the asset. The accountant cannot value assets in terms of future returns it is expected to generate. 2. Money measurement concept. The information in the financial statement must reflect only those facts which are capable of being expressed in monetary terms. There is no recording of good or bad performance in the financial statement. Therefore, facts which are important but cannot be expressed in monetary terms are irrelevant in the financial statements. Business entity concept. The concept implies that the affairs of a business are to be treated as being quite separate from the non-business activities of its owners. The items recorded in the books of the business are therefore restricted to the transaction of the business. No matter what activities the proprietor gets up to outside the business, they are completely disregarded in the books kept by the business. The only time that the personal resources of the proprietor affect the accounting records of a business is when they introduce new capital into the business or take drawings out of it. Therefore, there is a clear separation of ownership. The dual concept states that there are 2 aspects of accounting. One is represented by the assets of the business and the other by the claims against the business. The concept states that these 2 aspects are always equal to each other. As you know, double entry is the name given to the method of recording transaction under the dual concept. All transactions must have 2 aspects, 1 the debit and 1 credit. In accounting, there must be a giver and a receiver of value in every transaction. So therefore, we can express this out as there must be 1 debit and credit. The rule of double entry says that we should debit the receiver and credit the giver. The relationship of these 2 gives us the double entry system. Lastly, on underlining accounting concepts, we have periodicity concepts. The periodicity concepts hold that financial statements are prepared at regular intervals of 1 year, that is, every 12 months. For internal management purposes, they may be prepared for more frequently, possibly on a monthly basis or more frequently. Next, we move on to fundamental accounting concepts. Under fundamental accounting concepts is still further divided into 7. 1, we have the going concern concepts. We have consistency concepts. We have prudence concepts. We have realization concepts, accrual concepts, materiality concepts, and convention of conservatism. The going concern concepts. The going concern concept implies that the business will continue to operate for the foreseeable future. As a result, if there is no going concern problem, it is considered sensible to keep to the use of the historical cost concept when arriving at the valuation of assets. Consistency concept. The consistency concept says that when a business has once fixed a method for the accounting treatment of an item, it will enter all similar items that follow in exactly same way. Constantly changing the methods will lead to misleading profits being calculated from the accounting record. For example, depreciation of motor vehicle. Prudence concept. The principle demands the exercising great care in the recognition of profits while known losses are adequately provided for. The accountant should always exercise caution when dealing with uncertainty, while at the same time ensuring that the financial statements are neutral, that losses and gains are neither overstated nor understated. The accountant should make certain that assets are not valued too highly. Similarly, liabilities should not be shown at values that are too low. Otherwise, people might inadvisedly lend money to a business, which they would not do if they had been provided with the proper facts. Realization concept. The realization concept holds to the view that profits and gains can only be taken into account when realization has occurred, and that realization occurs only when the ultimate cash realized is capable of being assessed, that is determined with reasonable certainty. However, it is only when you can be reasonably certain as to how much will be received that you can recognize profits or gains. Accrual concept. This concept states that revenue and expenses are recognized and included in the profit or loss account as they accrue, not as they are paid or received. Materiality concept. In the preparation of the accounts, amounts of material value must be recorded. Material value refers to any information which the inclusion or exclusion from the financial statements to the end users, that's the users of the information. So this convention states that the accountants should not report certain economic events when the results of doing so are insignificant as to affect the financial statement, e.g. depreciation of stapler. And lastly, convention of conservatism. The accountant's view of the responsibility to the organization for whom he provides information is often expressed by this principle. It states that income should not be anticipated and all possible losses must be provided for. 2. Given a choice between two methods of valuing an asset, the accountant should choose the lower value. E.g., stock should be valued at the lower of cost and net realizable value. Net realizable value can also be referred to as the market value.